Glad you're with us today for the Lion's Share. I'm Mark Elliott here with the founder of Mitch Lyons Wealth. That is Mitch Lyons. Again, the website, MitchLyonsWealth.com, Lyons, MitchLyonsWealth.com. His book, Retirement of Steel, is there. Discover how to protect your wealth. The movie, the film, The Retirement Deception, exposing the truth about retirement success is there as well. Just go to the website. Check it out. Mitch is going to have webinars on there. There's all kinds of information on the website, MitchLyonsWealth.com. You can get the book right there on the website if you'd like to. We're talking about Roth and the Roth world, right? Should I convert some of that IRA 401k money from tax deferred, pay taxes on it now, so now it's in the tax-free world? Now, I had to pay taxes to get it to the tax-free, but all the growth, all of that afterwards, I've taken the government out of this play. Uncle Sam is no longer a partner with me and my money. That's kind of the main pulling point, I would think, is that now because you're talking about the tax codes that we know that the one big beautiful bill is permanent, but it's not permanent. If the next president says, nah, we're going to change that, we need more tax money. And we know the government is always looking out for us first, Mitch. But this Roth blueprint stuff, I mean, the Roth, I think, is really interesting because I think it gets confusing for folks. But for you, it's math.
Well, it really is. And I say that all the time. Listen, we'll show you your current situation, and we'll show you what could happen if you implement a Roth conversion strategy. And it's just math. We'll show you exactly what you'll owe in tax if you do nothing, and we'll show you exactly what you'll pay in tax if you make some changes and make some tweaks. And the big thing about it is it doesn't take a huge difference. Oftentimes it makes sense for people, and I won't get too far in the weeds here, but oftentimes, even if you're in a lower tax bracket in retirement, what we call your break-even tax rate, it may be a different number than what your actual tax rate is. So if we can get money out and again, factoring in the other things it affects, right? Your Social Security taxation, your IRMAA surcharges, if we can get it out even at a break-even amount, you've taken control away from the government. Because at that point, it doesn't matter what happens in the future. And with our national debt at over $38 trillion as we speak, depending on its errors, it's going up every day, as we know. Most people I talk to feel like tax rates are going to go up in the future. Well, if that's the case, then let's take action now and take control of our money and keep it away from what future tax increases could do. If it even made sense, if it even just was a break even now, it makes sense to do it because now you have control, and that's hugely important.
You know, one of the things that you said earlier about how you leave your money to the kids, right? And if you leave them your IRA, which now they're saying is like one of the worst things you can just leave to your kids because they're going to inherit it maybe in their 40s and 50s. They're making more money than they've ever made. Now your all stuff gets on there and they got to start paying taxes on that, and you've really caused them a lot of tax burdens. That is one thing that is really interesting because of when we mentioned the Secure Act in the last segment. The Secure Act also, 2019, 2022, right in there, that kind of time frame is when the Secure Act 1 and 2 went in. Well, the first one did away with the Stretch IRA, where you could leave your IRA to your kids. They could leave it to their kids. It was a Stretch IRA. You could just keep passing it down generation to generation. The Stretch IRA went away with the first Secure Act, which means all that money now has to be, and now it's a 10-year window. If I leave $1 million to my daughter, for example, she has a 10-year window to take that money out and pay the taxes on it. So the Stretch IRA going away has made Roth conversions maybe even more relevant?
Well, it certainly has. And to your point, you leave it to your kids. Again, they're going to be receiving that probably in their peak earning years, right? Which is a lot higher tax rate, more than likely, than what you might have been able to get it out at if we had done it strategically over time. And I run into this with folks who are like, geez, because nobody likes to pay tax, right? No matter when it is. It hurts to stroke that check. But the reality of it is you have to pay it at some point, or somebody's going to pay it. Unless you're just giving it to charity over time, there's strategies to do that if that's if that's your mindset. But if you're just looking to get wealth to the next generation, an IRA is really not a tax efficient tool to do that. Now, there are some things we can do along with RMDs and some life insurance strategies that we can take some of that money out of the IRA and use pennies to buy some dollars of tax-free life insurance. That's one of the huge benefits of life insurance is you can leave tax-free dollars to your kids. Uncle Sam won't get to touch those. So in a lot of cases, it makes some sense to take some of those distributions, whether it's RMDs or above and beyond that, and get those out, pay the tax, but now buy life insurance if you can qualify for it, whether it's a single life or a second to die policy on mom and dad. And we can run that analysis and get a lot more dollars to the next generation in a really tax efficient, economical model.
How do you help your clients determine if a Roth makes sense or a Roth does not make sense, or if it does make sense, how much, how often, how long of a term? I mean, there's a lot going on.
Yeah, and there's just a lot of variables in everyone's plan. So again, every situation, every client we work with is different. It's one of the fun parts of my job is it's kind of like, almost like an artist painting a picture. Every picture is a little bit different. And so again, it comes down to a math problem. All right. There's some nuance there, hey, even if I show you the math, maybe it's not impactful enough that you want to, that's your choice if you want to act on the math. But at the end of the day, our software takes all the questions out of it, because we can change some factors. Oh, well, what if I went up and I was willing to take more out at a higher tax rate? Oh yeah, let's change that. And we can change those levers and show you exactly what that would do. Or if they wanted to say, hey, let's say tax rates did go up in the future, what would that look like? And let's just pick a tax rate. So we can kind of paint those different scenarios for you and just let you make your decision. And it's not for everybody. There's some cases if somebody doesn't have that much income in retirement and they don't require much of income, maybe they're really never getting themselves out of that, 10%. And maybe they want to just leave their money to charity when they pass anyway. Well, then maybe the Roth conversion doesn't make sense, and we'll tell you that. But wouldn't you rather know? And I always say 30 or 40 years of saving for retirement is probably worth a 10-minute call to get us the info we need to run that analysis for you. So at least you know what you're saying no to. And if you're saying yes, then you may just put a whole lot more money in your pocket and or your beneficiaries' pockets.
Are there any common mistakes you see people make with this? Because it's not unusual for somebody to hear, I heard a guy on the radio telling me I should move some of my IRA money into the Roth world. I pay taxes on it now and I move it there. Boy, that sounds really good. I think I'm just going to do it. And they don't ever sit down with the retirement planning team like yours. They just do it on their own. Any common mistakes you see?
We do see a lot of unintended consequences that can happen, right? And that comes into, again, taxation on Social Security. How much are you showing in income? You might be getting 50% of your Social Security tax, and all of a sudden you do some Roth conversions. Now it bumps your income up. Now you're all of a sudden you get 85% tax. Or the other thing that people run into is the IRMAA surcharge. Maybe you're not thinking about it, but as you get to 65 and you have to start paying Medicare, depending on your income level, you can have some surcharges added to that. And that's based on income from 2 years ago. So if you did a Roth conversion at 63, how much more did that bump up your income? And because that's going to impact your Medicare costs on Part B and D and when you're 65, and that's 2 years down the road. So some people aren't thinking 2 years down the road what that's going to do to them. So it's things like that are important. And again, the software, the Blueprint software we offer takes all of that into account. It'll show you exactly what you could expect to pay in IRMAA surcharges in any given year. It'll show you what you're being taxed on Social Security, and we can make some decisions. And again, optimally do the Roth conversions to limit and mitigate not only your income tax, but IRMAA charges and taxation of Social Security.